Hey everyone, Texas Instruments offers passive income investors an interesting option. Offering a dividend yield over 3%, passive income investors are understandably interested in Texas Instruments stock. So in this video, I will evaluate this semiconductor dividend paying stock and answer if it's a good buy for passive income investors. So let's jump right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So I mentioned the company offers a dividend yield of over 3% at 3.15%. But more important than the dividend yield is perhaps the qualities of that dividend. How sustainable is the dividend? And that's what I'm going to look at in the next slide. So what I want you to understand is the dividend payout ratio. The dividend payout ratio measures the percentage of earnings per share that's paid out in dividends. It's a measure of how sustainable dividends are. For instance, in this first example here, you have a dividend per share of $1.75 and earnings per share of $2. That means that's a dividend payout ratio of 88%. That's relatively high. That means if earnings per share were to decline below $1.75, that company would be paying more in dividends than it's bringing in earnings. And just like a household that cannot spend more than it brings in earnings for the long term, in the same way, a business cannot pay dividends more than it brings in earnings per share for the long term. Sure, in the short term, it can borrow money to pay the dividend, but eventually it will exhaust its borrowing capacity. Additionally, it can pay dividends out of its savings, but eventually it will run out of savings. That's why in the long term, if you want sustainable dividends, you want a dividend per share that's below earnings per share at a comfortable level, like the second example here, where you had a dividend per share of $2.75 and earnings per share of $10. That's a dividend payout ratio of 27.5%. For passive income investors, what this means is that the dividend is not only sustainable because even a drop in earnings per share of 50% would still mean that the dividend per share is below the earnings per share. But it also suggests that there is room for this company to increase the dividend payment. So investing in this company brings with it the probability that the dividend per share will rise over the next several years. And finally, the last example where we have dividend per share of $3.50 and earnings per share of $1.45, that's a dividend payout ratio of 241%. The dividend payout is more than 2 times the earnings per share. When you see a situation like this, it's likely that this company is going to pause or reduce its dividend payment. That's very likely to happen in the near term unless the company can expand its earnings per share in a relatively short amount of time. Okay, so now that you've understood that concept, let's look at Texas Instruments' dividend per share and normalized earnings per share. You can see the dividend per share rising in the orange at $5.02 most recently, but the earnings per share have been well above the dividend per share, signaling that this dividend is sustainable and there is room to increase it over time. Revenue growth has been solid for Texas Instruments, $17.5 billion in the most recent trailing 12-month period. That's up from a little over $12 billion in the trailing 12-month period in 2015. That being said, analysts expect 2024 to be a down year for Texas Instrument. Revenue expected to decline by 10.9% and earnings per share expected to decline by 28%. But a recovery is coming soon after that, with 14% revenue growth in 2025 expected and 28% earnings per share expected, and 11.9% revenue expected in 2026, with 18% earnings per share growth expected in 2026. Texas Instruments is investing aggressively, increasing the manufacturing capacity during the downtime here in 2024, with the expectation that the semiconductor industry is highly cyclical to be ready for that next upturn, and that will put it in a position of competitive advantage in the industry when it does eventually hit that upturn, as it has done in the past few decades. Additionally, Texas Instruments has demonstrated economies in scale. Economies in scale is one of the most desirable characteristics you can find in an investment. In the example I have created here, sales grow from $100 in year 1 to $115.76 in year 4, while net income more than doubles from $4.50 to $9.47 in year 4. This company demonstrates economies in scale. As its revenue grows, its profits grow by a larger magnitude. Not every company can achieve this kind of effective growth. Here's how it works. This is a typical categorization of an income statement of a publicly traded company. Cost of goods sold is what's called a variable expense. That means cost of goods sold is connected to sales. Other expenses like interest, general and admin, and depreciation are not connected to sales. You can see here depreciation stays the same at 25 whether sales increase or not. The same is true for interest expense. It stays the same whether sales grows or not. You can understand your interest payments do not increase when your sales increase. Overall, businesses typically have a mixture of fixed expenses that are unrelated to sales and variable expenses that are. When sales increase, the business leverages those fixed expenses, as we see in this example, and profits grow by a larger magnitude than the increase in sales. So now that you see the benefits of that, you can see an excellent 41.85% operating profit margin, way above the 26% it had in 2015. As revenue has grown, Texas Instruments has increased its profitability. Similarly, consider the cash flow from operations. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. The company reported a net loss of $250. However, when you look at the cash flow from operations, it was a gain of $35. How can that be? Well, two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, the annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of % annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow, due to rising accounts receivable. And now you understand, look at Texas Instruments cash flow from operations to sales. 36.65%, up from around 26% in 2015. In all metrics so far we looked at financially, Texas Instruments has demonstrated phenomenal metrics. So finally, let's look at valuation. Texas Instruments is trading at a forward price to earnings of 23.79, a reasonable valuation given the company's excellent performance on profitability, on cash flow from operations. However, the one downside is the near-term headwind from 2024, down in terms of revenue expectations, down in terms of earnings expectations. So if I was to say if the stock is a buy, hold, or a sell, I would put Texas Instruments right on the borderline between a buy and a sell. Should there be a price decrease of roughly 5 to 10%, that could move the needle in changing my recommendation from a borderline to a buy. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.